We're going to look at long-term support and resistance, see where we're at relative to some key support levels, see what's actually working in an environment where it feels like everything is not working, and also look at it from an asset allocation perspective. Everything had been going up together. Now what? Now that we've had a couple days of a sell-off. We'll get to all of that and more, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome to today's final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Bit of a sell-off today. We're going to look at today from a lot of different angles. And anytime this sort of movement happens, and again, it's something I think we've all been expecting, at least at some level for the longest time, now the time is actually here. Hopefully, you've done some legwork ahead of the last couple days, had a game plan in mind on how to handle this sort of pullback. But we're going to take a look from a technical perspective, think about how the last couple days the sell-off fits into the long-term picture. Sort of a traditional sell-off, sort of offense at the bottom, but with energy really driving the way down. A lot of the defensive stuff holding up, but all things essentially down today. So we're going to take a look at it from a lot of different perspectives. Also, with the mailbag, we're going to answer some really interesting questions about how stocks move relative to earnings, which is actually a really important topic now when stocks are moving related to a lot of news flow. So should be an interesting show for sure. Wanted to get to the upcoming schedule on StockCharts TV and on the final bar. Tomorrow, we have Julius DeKempener, who's a fellow StockCharts contributor, focus on sector rotation. Should be really interesting to see what he has to say about all the movements we've had in the markets this week. On Thursday, we have Axel Kabar. He's a technical analyst based in Bulgaria, which should be really interesting to hear a European perspective from everything that's happening this week. On Monday, Behind the Charts, we'll be back with our guest, Fred Meisner. Fred's the creator of the Fred Report based in Atlanta. Really fascinating technical analyst that you're going to want to hear from. On March 3rd, we have Scott Smith from Briefing.com. Starting on March 6th, the final bar is going to be on the road. We are heading to New York for the Traders Expo. We're going to be back there through the weekend, doing a lot of really cool interviews. I'll be presenting. So if you're going to be at the Traders Expo, please make sure you come to my session and say hello afterwards. Love to meet you in person if you're going to be there. And also, we captured some really interesting interviews. On this show, on the final bar, really excited to tell you, we're going to have some guest hosts during the time that we're gone to share sort of a current market perspective. So I'll be sharing some long-term stuff. We'll have some guests, familiar faces from StockCharts TV helping us keep the final bar going. So it should be an exciting couple weeks here as we deal with all the market distribution. So let's get to a market recap. So by any stretch of the imaginations, today was certainly the follow-through to the downside that we talked about, right? With yesterday, with the sell-off hitting that key 3210 level on the S&P, the question was, do we see further downside? Do we see follow-through today, or does that key support level hold? I think we got our answer today with the S&P down over 3%, still sort of getting those final ticks all lined up, but overall, pretty significant down day and fell into the close. So it was distribution going into the end of the day. Small caps down over 3%, 3.33%. Mid caps down the most, down 3.5%. Even the S&P 100 down pretty significantly. So across the board, plenty of distribution. That sell-off between yesterday and today has pulled the VIX up to 28, which is pretty high. We've talked about the VIX as a fear gauge, and I cautioned you yesterday, just because the VIX has gone up to a certain level doesn't mean it can't go much further, and we saw that it's up another 12% today, now up to 28. Let's look at a chart of the S&P 500, refreshing it here for the close. So what I wanted to highlight here is obviously this divergence has finally played out. We've seen some of these divergences before. I always like to point them out as a potential top, and this is certainly where it seems to have been fairly indicative of an overextended market. We've sold off through the 50-day, now have gone right through the 38.2% level, which was just below 3210. So that was sort of the next line in the sand. We've blown right through that. We're now at a 50% retracement of the low from last October to the peak that we had last week. And the question is, where do we go from here? And again, I don't know as much as you don't know, but based on historical probabilities, I would be looking around this area. This is the 200-day moving average around 30.45, 30.50. We have the low from last December, which is around 30.75, 30.70. And then we have the 61.8% retracement level. All three of these, this is sort of a confluence of support all around this 30.50 to 30.70 level. And, you know, again, gun to my head, where would I expect some sort of pullback to bottom out, or where would I expect a downside? That would be sort of the downside risk based on just a quick assessment of the run. And again, Fibonacci retracements tend to work because once you've had an initial move and you retrace within that range, those are the levels at which pullbacks tend to happen to. So that's sort of the downside risk from what I'm seeing. A break below the 200-day would be obviously fairly significant. In 2 days, we have gone from having a fairly constructive RSI to an RSI below 30. We're oversold. You know, obviously, if you can look back to other times we've been oversold, but those have been in bull market phases. Arguably, we're no longer in that because we're now below the most recent swing low. We have not established a lower high, but that's what I would be looking for next, right? Once we digest this sell-off we're in the middle of, the question is, where do we establish some sort of range and where do we go from there? So in the short term, we're oversold. We can go further. That's absolutely true. I think the downside on the charts, looking down here to the low from December, Fibonacci support, the 200-day, all within that range. So that would be the next level I'd be looking for in the case of further downside. Let's look at what's actually happened today and how that fits into looking one level below, looking under the hood a bit here. So defensive sectors were certainly the best, although they were the best of the worst. Everything was down. Consumer staples down the least, followed by utilities and real estate. So certainly a move toward the more defensive side of the markets. Energy dramatically pushing the way lower with oil prices and commodity prices really selling off. So you have materials and industrial, sort of the MEI trade, the late cyclical leadership, all pushing the way down, followed by financials and then technology. So, you know, certainly defensive doing better, but everything on the way down. In terms of global themes, you know, pretty broad-based sell-off. The only things that were actually positive were some of the Asian-oriented markets like South Korea, Singapore. South Korea is a market that sold off extensively before today, so you know, we'll see if that really means stabilization. European markets really the worst out of all the global equity ETFs we would follow. In terms of industries, not a single industry up on the day. According to the Dow industry groups that we do. Some of the more defensive things like insurance brokers within financials, and again, those were down, but not down nearly as much as the market. And then it's a lot of, you know, really safety trades, soft drinks, tobacco, personal products. These are sort of the necessities that you would want to hold on to, even if the world is ending or if it feels like that. In terms of driving the way lower, it's anything transportation related, luxury related, hotels, recreational services, hotel and lodging REITs, transports, all of those things. So airlines are really down the most, down 7%. That chart had looked a little relatively weak. Now it looks really bad because we've broken down through a series of support levels. We have lower lows, lower highs. Oversold, but nearing the extreme oversold condition. And we've often said, never confuse the bottom of the page with support. So this is a group that's now broken down through key support levels. The relative strength has gone to new lows for the year. There's no indication on this chart from my read that we've bottomed out. That's just telling you there's a ton of distribution. Until you see some sort of stabilization, you know, in general, you want to hold off and see where things sort of bottom out. So what actually worked? Was anything actually okay? Similar to what we talked about yesterday, things like the CBOE, CBOE, these are in the exchanges groups holding up okay. And again, I guess the idea there that you know, people using, you know, a lot of volume with people hedging positions, that would make sense to me. Hormel, so within the staples group, was up a little bit yesterday, down from the close, but rallied a little bit, but a little bit of a gap up here. Also Xerox on there. So some earnings-related moves that held up okay, but overall, pretty much everything showing more weakness than strength, as you could probably guess. That's our recap for today. I want to rotate right into our next segment called Banking on Breadth. So when we talk about market breadth, it's basically saying, all right, the market is doing X. What is the average stock doing? What sort of participation? For me, breadth is all about the word participation. You know what the broad index is doing. You can see that the market's sold off. What does that mean relative to the individual stocks that make up those indexes? So we're going to slice it from a number of different angles. We're going to go through my breadth indicator chart list that I use pretty often. If you don't have this, and if you want to shoot me an email, thefinalbar@stockcharts.com, I'd be happy to send you this chart list. You can save it to your own login. So the first one is looking at the S&P and the New York Stock Exchange and the percent of those stocks above their 200-day moving averages. We highlighted this bearish divergence, and again, we saw a number of divergences going into the last 6 to 8 weeks, right? These higher highs in January and then February, lower peaks in the breadth reading. So this is less stocks back above their 200-day as the S&P is pushing to new highs. That's sort of the warning sign, and we've now sort of gone lower. What's interesting is even with this pullback in the last 2 days, which has been fairly extreme. Remember, most stocks, most S&P names and most NYSE names are still above their 200-day moving average. A majority are. So 2/3 of the S&P is still remaining above their 200-day, just like the broad indexes, right? Here's the index, and then there's the 200-day just below, as we mentioned earlier, around 30, 45. So most stocks, 2 out of 3 stocks still holding up okay. If this goes much further down, that's telling you that you've had a real capitulation with a lot of stocks now breaking down through that key support level. If you look back here in 2019, also in 2018, with the exception of the big sell-off into the end of 2018, you can see that a lot of times that 50% level ended up being pretty meaningful. So as long as we remained above 50% of the S&P above their 200-day, that ended up being a short-term pullback and not something deeper and more meaningful. So I think that would be, if we get this breadth line going much further down, which certainly can happen, looking at that 50% line in pink here on my chart is an important one to look at. Looking at the shorter term reads, this is the percent of S&P names above their 200-day and then above their 50-day moving average. You can see that actually has broken down. So now 1 out of 3 stocks is still above its 50-day, or to put it another way, 2 out of 3 stocks have broken down through their 50-day moving average. Why that's important is at the beginning of the year here, that initial push up in January, over 80% of the S&P were above their 50-day. That's all rotated down. So, 45, 50% of the S&P has now broken down through its 50-day moving average, just like the S&P. The only thing that's remaining are things that are really still, had been so extended, had been in such a strong uptrend that they're still able to hold that level. We're nowhere near some of the levels that we've been at previous pullbacks, so it's suggesting still, based on that read alone, further downside is possible. Now, some of these breadth readings, to be honest, don't update until we're able to process all the closes, make sure we have a proper read on all the data. But, looking at the trends going into today for sure, this one does update. This is the advancers decliners. So, it was almost a 90% day looking at the New York Stock Exchange read. Yesterday we had 90% of the NYSE down yesterday. Today it didn't appear to be quite that bad, but boy, really, really close. In general, what you look for are some spaced out capitulation days. So a couple days where you have 90% down days, that tends to be a pretty negative sign if you've had that. So I think on any rally, you'd want to see if you have another push lower, but only 10% of stocks up today and yesterday as well. So obviously most things down. This is looking at new highs and new lows. You can see how we'd had a healthy number of new lows over the last 6 weeks on the New York Stock Exchange, not nearly as many on the S&P. Only 18 S&P names yesterday going to a new 52-week low. I would expect that number to be a lot larger today once we get that final read. This is not updated for it, but you can see that there was a big jump in the number of stocks making new 52-week lows yesterday on the NYSE. So tomorrow morning, there'll be an interesting time to see sort of where those were at and how much of a sell-off this was in terms of stocks making that new 52-week low. And I would be looking back to where we were back here in May and also in August to see if we get anywhere near those kind of levels on a down day like today. We can see the sell-off here on a closing basis. You can see how quickly that's moved down to where we're at now. This is the breadth read we usually use, which is looking at cumulative advanced decliners for the S&P and then the other exchanges. This is not updated yet for today, so I'm going to guess that this is now broken down through some key levels here. What was interesting here is the fact that small caps, mid caps, and the NYSE did not make a higher peak here in the last week, just like the S&P did. And that's sort of, what we talked about, sort of that weakening breadth below the hood as it appears to have sort of played out here. It'll be interesting to look on the small cap breadth and also the mid cap breadth if we break below this swing low from the last week in January, just based on a cursory glance at the data. I think we're going to do that on both of those measures, but remains to be seen. We'll see how the data sort of lays out there. Going further down just a little bit, I wanted to hit to the McClellan oscillator. So Tom McClellan writes on our top advisors corner, if you've not seen his research on our platform, I'd encourage you to go to the articles page on StockCharts.com and go to some of Tom's work in the top advisors corner. But he occasionally talks about the McClellan oscillator. It really was created by his parents, his father Sherman McClellan and his mother as well, who were sort of pioneers in this particular look at breadth. It's sort of doing cumulative advanced decliners, but it uses exponential moving averages as a way to smooth it out. And the two reads we'll look at first is the pure McClellan oscillator, and essentially it fluctuates around zero. Above zero means the more accumulation. Below zero means more distribution. You can see it's fairly noisy, so it's more of a swing trading indication of sorts on the broad S&P. As you can see, it's been leaning negative. It's been negative for a couple days now. Really didn't get much in the positive range in the middle of February. Has made a series of lower highs, but now firmly at the lower end, and it's back down to some of the lowest readings that we've had for the last 12 months. Now, again, this is more in a bullish tape, so you can see that those down moves in the McClellan oscillator have lined up very well with market dips. But again, we're not comparing this necessarily apples to apples. If this is the beginning of a much further sell-off, then this number can get much worse. So we're kind of at that point. If you look at some of these charts, we're at that point where is this just a garden variety pullback, or is it the beginning of something deeper? And again, with a lot of the reads that I'm sort of showing, it feels like a little more deeper in terms of time and or price. It could be a combination of both. The final one I just want to point out very quickly was the summation index, which basically is a cumulative read of this McClellan oscillator. It takes that over time. This is now broken back down through the 50-day moving average. I'd be looking here to see if it makes new lows below the low we had here last October and December. If that's the case, suggests certainly some inherent weakness in the overall breadth reading. So that is a quick segment on banking on breadth. Again, if you don't have these charts put together, you are welcome to use the tickers that I showed you, or just shoot me an email, thefinalbar@stockcharts.com. I'm happy to send you this chart list. You can save it to your own login. We are going to take a quick commercial break, answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the show. I'm your host, Dave Keller. Thanks for joining us on the Final Bar. We're going to answer questions from the mailbag in a moment. Just wanted to remind you a couple ways you can get your questions to us. Number one, thefinalbar@stockcharts.com. Send any questions. Nothing is off limits. Number two, go to us on Twitter @FinalBarSCTV. And number three, just during the show, just put a quick question in the Q&A. We capture those every day. We incorporate them into a future mailbag segment. On that note, let's answer the questions from the Final Bar mailbag. So one of my favorite things to actually hear from you watching the show and get some of your questions. I feel like with a 30-minute show, we have to tear so quickly through a lot of the charts that we're looking at. So questions help me understand where we need to spend a little more time. We're going to try to go through 4 questions. I promise my wife, as always, not to take on too many questions, so we're going to stick with 4. Question number 1, I enjoy watching your shows on YouTube and StockCharts. Let's just pause there for a moment and say thank you. Number 2, I have been using moving averages on some of my indicators, such as RSI, the money flow index, the Scooter ratings, and other indicators. What's your opinion on the use of this form of evaluating the market? Really, really good question. And I would say there is certainly some validity to using moving averages on other indicators. If you think about it, something like the PPO, the weekly PPO that I often will refer to, that's this right here. MACD as an indicator, or PPO, the percent price oscillator, is basically designed from taking a moving average of one indicator. So the black line is the difference between the 12 and 26 bar exponential moving averages, and then this red signal line is a 9-bar average of the black line. So it's doing exactly what you suggest, and that's what Gerald Appel actually design. That's what the MACD is actually derived from. So you are in good company when you think of doing that. The question is always using it with some sort of discipline, with some sort of disciplined, consistent process, and I think that's where the trick is. So here I'm looking at the chart of Home Depot, I'm looking at the RSI, and then I put a moving average, a 21-bar moving average on the RSI. At the bottom, I'm showing our scooter rating, and I'm doing a moving average, a 20-bar exponential moving average of the scooter rating. So you can certainly use these in the same way that you would use the MACD or the PPO. If it goes above a smoothed out version, that would be more positive. If it goes below, that's more negative. What some people do is actually ignore the black line, ignore the raw indicator, and just use the moving average. So just use the slope of the moving average as a more, maybe smoother indicator. And if you're using it as an input in any sort of quantitative approach, any sort of trading model, a lot of times taking a moving average, just that simple exercise can smooth things out enough to give you a good read. I do think using the moving average on the scooter rating is actually pretty interesting because it'll show you when something's been underperforming and then it rotates to be more outperforming. So Home Depot was below the moving average here in November and December as other stocks were, selling off less or doing better going into the end of last year, but then started to really improve in 2020 as it turned, really started to emerge. Relative strength was good, and you can see that by the fact that it's outperformed most of its peers over that time. So the short answer is yes, I think that's totally valid. Number two, I would experiment with it and see what works for you. And number three, the key with any of these things is to use it consistently, use it with discipline. That's where it's going to make sense. So thanks so much for that question and the kind words as well. Question number two was related to an article about Lloyds, a bank based in the UK, and how the price was up even though profits were down. This is an earnings-related question. Is the jump in Lloyds Bank a case of bullish sentiment associated with rising on bad news? Is it an unexpected turnaround for the bank? What does that mean relative to the numbers? So here's a chart of Lloyds Banking Group. It's LLOY.L. That means it's traded on the London Stock Exchange. So if you're not familiar with some of the non-US tickers, that's usually how you do it on our platform. And it's this day in particular. This was the 20th, which was the jump. So the profits were actually down. They actually made less money. They brought in less revenues. Why is the stock up? And I often would tell analysts when I would teach them how to use technical analysis, sort of new financial professionals, teaching them what charts were like, I would say there are plenty of bad times to own good companies, or good companies don't always make good stocks. Different ways to say the same thing, which is when we're thinking of the company, we're thinking of the management team, we're thinking of the earnings. That is one set of indications of the prospects for the company's growth. The chart is doing something different. It's looking at what people expect about those numbers and what people perceive about those numbers. It's all about expectations and where we're at relative to expectations. So a stock can do this, go up on bad earnings because it depends on what quote unquote bad earnings do. If they lost, a decent amount of money, or if they made less money, it's all about what they did relative to what the expectations were. So if you read the headline and it says profits fell or there's less profits, that doesn't necessarily mean it's a bad thing for the stock because it's all about where people expect it. A lot of times people will lower their expectation going into an earnings release, and that means they can surprise to the upside and everyone feels a lot better because it's not as negative as it could have been. Since then, I took the snapshot here on the 20th. Since then, the stock has done this, along with most equities, has sold off in concert with everything else. So I just wanted to focus on that day, but that's what that would really. So I would encourage you with earnings releases, when you hear about profits, when you hear about sales, revenue targets, always think about what the number was relative to the expectation. That's going to be the most important thing. As you probably know, on our simple summary page, we have added information for U.S. companies on earnings, and we are going to be adding much, much more going forward. So you will be able to answer all those questions very soon right on our platform. Question number 3. Are high beta sectors the worst performers in a sell-off such as today? That came through our chat room yesterday, and I just wanted to highlight, I have a ratio somewhere here. Let's see how quickly I can find that in a pinch. I think it's right here. Something called high beta. There we go. High beta versus low volatility. This is a ratio that I have on my ratio chart list. It's looking at the S&P high beta ETF, SPHB, versus the S&P low volatility ETF, SPLV. And it's just the ratio of the two. If you think about it, high beta are, just as you suggest, in an up market, when the market's doing well, the higher beta names tend to do well. These tend to be more speculative, and higher beta just means If the market's up and the market goes up 1%, higher beta means it will tend to go up more than that. In an up market, a higher beta name will go up like double or triple what the normal market will do, because it's a more leveraged play. It's more speculative, more risky, and as a result, it will have exaggerated gains and losses. So in an up market, it pays to own higher beta names because they tend to do well. What's happened so far year to date, though, is that underperformance of higher beta names has actually not been a new thing. That's actually been in place since the end of last year. A lot of things sort of turned on a dime starting in the new year after the holiday season, and this ratio of high beta versus low volatility has already been in a downtrend. So we were right about here when the sell-off started, so I was not super surprised that this ratio has gone down, because it's actually been rotating lower well before the sell-off that we saw this week. But in general, you're absolutely right. In a sell-off, higher beta groups will tend to do worse than lower beta or lower volatility groups. You're absolutely right. Our last question, right on time, honey, is aren't high beta sector, that was the last one. Oh, how do we create a chart list from members of an index? I thought that was a great question, because it gets to how we actually use the StockCharts platform. This, I actually chatted with Chip Anderson, our founder, to make sure I knew the best way to do it, and not surprisingly, there was something I did not know well about StockCharts. I'm still learning too. If we create a quick chart list. This is from my member dashboard. I went to chart list, clicked on new. I'm going to create a new list called the final bar. You'll see here at the bottom, a lot of people kind of glaze right past this. You can add individual charts if you want. You can add a series of tickers separated by a comma. You can actually upload a CSV file. So if you have a list of tickers from your brokerage account or something, you can easily import them into a chart list, or you can save from group. And this is the easiest way to get members of an index or members of a sector or industry group right into a chart list. Click on From Group. Here are all the predefined groups. So you can go to the broad indexes, you can go to the S&P sectors, and you can bring them right in here. Down here at the bottom, you'll see From Industry Groups, and you could bring in the Brewers Group and hit Add Charts, and it will put that list of tickers right into your chart list. You can pick a chart style, copy it for your whole list, and you're done. So that's the easiest way. Go to your member dashboard, click Chart List, and then say From Group. Thanks so much for all those questions. Those were 4 questions directly from you guys in the last couple days. Very much appreciate it. We need to wrap the show, folks, with the 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar, I hope they are right now. We talked about the sell-off from an equity perspective, looked at some of the group and sector themes that were driving things down. I do want to look at an asset allocation perspective with our 3 in 3. So 3 charts of non-equity asset classes. The first one is the 10-year yield. As we know, yields bottomed out here going into last fall, rallied back up almost to 2% on the 10-year, but now have gone back down. When this was selling off, and I saw the chart of the TLT breaking out, I remember tweeting out last week, this looks like a bullish pennant or a bullish flag. Looks like the TLT, if it breaks out, it has much further to go. And one of the comments I got back was, but how far could yields go down, right? Isn't there a ceiling because yields can't go much further down? And the answer is it can always go much further than you expect. As we've talked about, this is a time where we're going to remember that never confuse the bottom of the page with support. Just because it feels like yields are extremely low, they can go much lower, right? So yields down below down toward 1.3% on the 10-year. The second chart is gold. I thought this was interesting because it gapped up yesterday, but sold down into the close. Down again today, actually, so following down. So instead of a safe haven being gold, it was more going to fixed income today, more to the bond markets. Commodities as a complex sold off pretty quickly, and gold down as well. So a little unusual. Don't just assume because the market is down that something like gold is going to work. Make sure you look at the chart. And our third chart is our intermarket analysis. Look, we've been talking about John Murphy a lot recently, and as a quick teaser, we were hoping to interview John very, very soon to share it with you on the show here. But I did want to show, this is my main intermarket analysis view, and this is the S&P 500 in black. This is gold in the goldish color, the 10-year bond ETF, or the long bond ETF, the TLT here in red, and the dollar in green. You can see a lot of these have been going up, but look at how quickly they've all rotated lower. When I presented to the CMT chapter local in Seattle last week, we looked at this chart, which at the time, everything was going up. And I remember the comment was, this is unsustainable. Everything can't keep going up at the same time. Something has to give. Where's it going to be? We have the answer now, and it's in the form of stocks. It's in the form of oil. The dollar has pulled back a little bit, but overall the trend on the dollar still remains positive. The trend on bonds remains positive, and even with the pullback, the trend in gold remains positive. So we'll have to see how that plays out, but this is one chart I would encourage you to pay attention to see how they move relative to one another. And ladies and gentlemen, that's our show for today on a sell-off day here on a Tuesday afternoon. I want to thank you for joining us every weekday after the close for the final bar to compare today's trading to the short term and then connect that to the long term, have a proper long-term perspective. Please keep your questions coming to us, thefinalbar@stockcharts.com. Also go to our YouTube channel for our YouTube Q&A coming up this Thursday. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night.